All right, welcome back. This is the Something Venture podcast. I'm Kent Lindstrom. I am your host. I am also the co-founder of 8-Bit Capital, which I mentioned because people have been asking me who I am or why do I have a podcast, and I'll address that in some future episodes. I will also point out you can Google me. There's not a lot of Kent Lindstroms in the world, with all due respect to any other Kent Lindstroms that might be in the world. But in any case, this is kind of a special thing, this episode of Something Ventured. My guest today is Jaclyn Hester, and she was not, but now is, a partner at Foundry. Now, when we had this conversation, she had not yet become a partner, and now she has joined Brad Feld, who you've heard on the podcast as being a partner at the venture capital firm Foundry. So, first of all, congratulations. So real briefly, here's why that's a big deal. If you've listened to this podcast, you kind of get the idea. There aren't that many venture capital jobs in the world. It's a very special and kind of, in some ways, lovely job. And there's very few of those jobs in the world, and most of them are held by men. There's relatively few women. There's even fewer people of color. If you've listened to this podcast, you get that idea. And we've talked to a lot of women who are partners at venture capital firms. From Monique Woodard, coming from the wilds of Florida, rural Florida, to become a venture capitalist. Recently, Trey Vassallo came from rural Minnesota. Maybe it was rural Michigan. I'm sure I'm offending one of those two. But in any case, I've tried to have a lot of women on who are in the venture capital business. It's still unfortunately rare, but nonetheless special to have another female partner, and that's what Jaclyn has become. So, simply this. Congratulations to Jaclyn. Enjoy this conversation. All right, welcome back. This is the Something Venture podcast. I am Kent Lindstrom. I am your host. My guest today is Jaclyn Hester. How are you doing?
I'm well. How are you doing, Kent?
I'm doing great. I guess that's a very specific question these days, but Jaclyn... Exactly. Jaclyn's a principal for now at the Foundry Group, which, if you've heard the Brad Feld podcast, that's the same group. She was a corporate lawyer, not the first lawyer on this podcast. Dave Hornick was a lawyer who became a venture capitalist. She's been an entrepreneur, part of the team that built Fair Harbor, and now leads or is a big part of Foundry Group's effort to invest in other funds. And we'll explain what that means, but this is great. So how are you doing?
I'm doing well. I spent some time visiting family throughout the summer, road tripping with a toddler. So I'm happy to be back in Boulder at home and not in the car.
And you are not, so Foundry Group is famously not in Silicon Valley. It's in Boulder, Colorado.
Yes, we've been in Boulder since the beginning, and we love it here. And we think it's actually great positioning for us. I hate to admit that I live in the middle of the country, being a coaster. Right. But we're right smack in the middle, so it's actually super easy to get to both coasts. A bit of a shorter flight out to San Francisco and out to the Valley. So we think we're super well positioned. And we also believe that great companies can be built anywhere. And so not only do we invest here in the Boulder, Denver market, also on the coast, but then also throughout the rest of the country and a little up in Canada.
And that was the topic of Brad Feld's new book, right? The Startup Community Way.
Yeah, I have 2 copies on my bookshelf that you can see behind me. So.
Nice. So Colorado, like, how did you end up in college? I mean, I get how Brad did it, but how did this happen for you? You went to college. You're going to be, well, first of all, you're going to be a lawyer, right? So you're not thinking you're going to be a venture cap. I mean, that seems like an expensive path, right?
Yes. So I ended up in Colorado because I did not realize how expensive law school was. Nor that I would be the one paying for it. And the way to finance that is loans when you don't have a large savings.
Yep.
Having in New York in my early 20s and sort of spending every last dollar that I made every month. Right. I was in New York in the sort of 08-09 timeframe. I had gone to Emory undergrad, knew I wanted to do something in business. I certainly didn't know anything about venture capital or really investing. I grew up in a small town. My parents owned a small retail jewelry store. People that I knew that were successful were typically doctors and lawyers. Right. Science was really my thing. So lawyer was sort of the path for me, but I had sort of strayed into wanting to do maybe marketing or consulting or something else in business. And my senior year took a business law course that was like the class everyone hated, and I liked it and was good at it. And so that seems like a good idea. So I moved to New York. I spent a couple years at a law firm, 0809 timeframe, everything crashing. And much to the chagrin of every lawyer that I worked for in that firm, said, don't go to law school. And I decided to go to law school. I applied to all private schools, and someone mentioned how expensive it was and who's financing this. And I realized that was me, and I didn't have any savings. And so I rethought my list and thought about, applying to state school so I could get in-state tuition and or a larger scholarship. And so Colorado happened to be the place where my husband, now boyfriend at the time, really wanted to get back to. He had spent time there as a kid, and he wanted out of New York. And so I applied, and I got a scholarship, and I went out to visit, and it was beautiful. I fell in love with the program, and sort of, they actually have a big focus on entrepreneurship and tech. And so that's really how we ended up here about 10 years.
So your parents were a little bit, retail jewelry, they're entrepreneurs, right?
Yes, in their own way, very much so. And self-made, like my dad sort of stumbled into it, given us a love of geology, but his dad was a butcher, I think. So definitely.
It's interesting. The women I've talked to who end up in, venture capital or running companies, that their parents were entrepreneurs. Like Adriana Gascoigne of, Girls in Tech was, her grandmother ran a candy factory in Mexico. Like, obviously not tech companies, but like small town, built their own businesses.
Yeah, I think there's a bit of so I also have immigrant history, I think, which also is part of that. So on my dad's side, it's two generations in, but my mom, her parents are Holocaust survivors. And there was something entrepreneurial in that, just like sort of the willpower and doing something, like the ability to survive that and sort of doing something different. So they were both in the underground fighting back against the Nazis. My grandmother was like 14 when the war broke out, survived by herself. Her whole family was killed. Pretty wild. But so they came to the US and they had nothing, and they had to start from scratch. And so they built a farm, and they had a grain and an egg business, which my uncle then took and made into a real business. Very entrepreneurial. So that's another influence on me. Turned that into a major business and exited to Land O'Lakes years ago and still works with them. And then on my parents' side, my dad didn't come from very much, was a social worker, and just was doing child and family therapy, and it was hard on your soul. And he had a love of geology and travel, and another guy that sort of wanted out with him that he had gone to grad school with. They started this business of buying and selling gemstones all around the world and turned it into a small business in Old Lyme, Connecticut.
That's so incredible. Having been an entrepreneur, I see it not just the tech thing, but I see it everywhere. When you're just walking down the street and you see like a donut shop or a dry cleaner, and you're like, man, somebody did that. Like somebody went out and they figured out how to do it, and they get cash every month, and they pay the bills, and they get customers. Like it's, I don't know. I'm always impressed, even if the entrepreneurial activity is making donuts for people.
Yeah. I think there's sort of this glorification of the startup entrepreneur and the tech entrepreneur that we all think about all the time, of like, what does the face of that of an entrepreneur look like? And there's a difference between, a startup or a tech startup and entrepreneurship, which is everywhere, which is, like you said, the dry cleaner and the coffee shop. And, it's often families that either are immigrants or sort of just like need to start their own thing in order to generate an income, because they don't necessarily have access to the track that other people do. And so entrepreneurship's everywhere.
And it's amazing on the high end of this, you have a fund. We'll talk about that in a second. Our fund, 8-Bit Capital, you end up raising money from people who built companies, but they're not tech companies. They're like, the pickle king of Iowa, and the guy who makes the fastener that does the thing that everyone needs that you've never heard of.
Businesses where the generational wealth is, the Zipper family, and also, food and ag businesses. Cargill is another one. And, but yeah, it's rarely the startup. I think we're maybe in a new generation of that, but it's the longstanding ones that have been around.
So you're now though, when you're at Perkins, it's Perkins Coie, right? Is that how you pronounce it?
Yes, that was the law firm I was at. Yeah.
So you're at the law firm. You're kind of at the other end of an entrepreneurial experience at that time, right? You're advising other people. It's a pretty famous, respected firm.
Yes.
How do you how's that experience, and how do you come over to like, hey, this is not what I'm doing for the rest of my life?
So I think I must have, well, maybe I didn't always know, but I always had a feeling that there was something more interesting about the businesses themselves than about the legal aspect. I think for me, it felt like being the attorney was a way to be connected to the business. And I like, I was good at it. I was good at school. So I was good at law school. And I think law school is an incredible education. It makes you think a certain way, that sort of, I think no other education can. But I got an MBA when I was in law school, just as hey, this will make me a better lawyer and help me get a job. And that's really the only, my only thinking around it. But I must have known that I liked the business side maybe better. The other thing leading up to my role at Perkins, was at Baker and Hostetler for a year before that, and I actually did a bunch of startup work there, which I loved. And the team sort of like people left, and so there wasn't really anywhere for me to be as a very junior lawyer. But that's how I ended up at Perkins. But I think the most important thing are two layers. So one is within the CU system, sort of, especially in the law school and then in Boulder generally, just so much startup activity. And I sort of threw myself into it once I realized that was interesting to me. So I took a class on venture capital while I was in the law school that Jason Mendelson, I was one of the founding partners of Foundry Group, teaches. And the textbook is a book that he and Brad Feld wrote together called Venture Deals that everybody should read. And that was my intro to venture, but I still never thought of venture capital as a thing I could do it. To me, it was like a thing that rich guys did. And but it was cool to learn. It was my way to learn about entrepreneurship and startups.
It is a thing that rich guys do. You were correct.
Now other people do it too. Yes. And so I also sort of through that, Phil Weiser, who was the dean of the law school and is now the AG for the state of Colorado, and a guy, Brad Bernthal, I had all these champions in sort of the Boulder entrepreneurship world that would put me into roles. So one thing I did was I ran a organization called Start Colorado, and that's how I met Brad initially. So I had these loose touch points, didn't realize there was a career path there for me. And Foundry did, very adamantly never hired anybody. And so all of these things are sort of leading into, I liked entrepreneurship and startup. I knew that's where I wanted to spend time as an attorney. And then at the same time, my husband and his family started a company called Fair Harbor, which his two brothers were the original co-founders of, and he joined. It was one of the very first people on the founding team. And I really I lived the entrepreneurial journey through them. I also did some legal advising for them, but sort of lived it with them. They offered 24/7 customer support from day one, which was a huge selling point. They were basically bringing technology to the touring activity industry, and so selling to a lot of mom and pop shops at the beginning and SMBs, and so offering 24/7 support across the country meant someone had to answer the phone. My husband was customer experience by himself for a year, so right. I get it. And so in any case, I sort of lived that with them, and it was so much more exciting what they were doing versus what I was doing. And then as I went to Perkins Coie, which is a wonderful firm, and it's great, especially in the Denver market, I worked in the M&A practice. And middle market M&A, when all you really want to do is be close to startups, is just right. Unfulfilling. So I think I knew it wasn't for me. I love people and building relationships and sort of really being directly connected to the business. And there's an aspect, I think, of being a junior lawyer across the board, but then also M&A in particular, where you just don't do that. And so I was definitely craving something I knew I wouldn't get there, even if I stayed for years and years and became more senior. And so I'm almost done with this ramble, but I was looking at a blog online about what can you, after being a lawyer, what can you do? And so it was never clear to me that you could do anything else. And so I read a blog called Life After the Law and bought this woman's book, and it changed everything for me. And then I remembered that Jason Mendelson had been a lawyer. And so when I ran into him at the right time when I was looking for a new role, I started to talk to him about that.
And so it's pretty difficult to find a job in venture capital as it is. If you're in Silicon Valley, where you throw a rock and you hit a venture capital, the front door of a venture capital firm, and you're in Boulder, Colorado, and yet you managed to land a job in venture capital. That's fairly extraordinary. Was it luck? Are you the Obviously you're a genius and it was perfect person, but
I think it's a big mix of luck and a concept that I'm sure you're familiar with called Give First, which is very much in the Techstars ethos, but also us at Foundry and the Boulder ecosystem more broadly, or the Boulder startup community, which Brad would correct me between ecosystem and startup community. But the idea there is, it's not altruistic. You give first, knowing that at some point you will get something back, but you sort of you put a lot of good juju out there, and one of those things will come back to you. And I think that's probably something that was always, that concept was probably always part of who I am and sort of who my family is growing up, and just sort of saying yes to things and showing up for people. And putting yourself out there. And so, taking a little bit of risk and trying things. And so I've always done that. And I think, so it really resonates with me hearing it as a concept, Give First. But for me, it was, I had, said yes to a bunch of things. I did the Startup Colorado role while I was finishing my JD and my MBA. So it was pretty intense finishing up. And I remember that I was the TA for the venture capital class. And they called me and they were like, hey, what if we get somebody else to do that job and we give you this other job where you'll be the executive director of Startup Colorado? It's probably just a couple hours a week, which I knew from the people telling me that was just totally not true. But I said, you know what, these guys have done a lot for me. And I think this, I'll get exposure to Brad Feld and other interesting leaders in the community. I should just do it. And so having that attitude of just saying yes to things and who knows what it'll turn into, I think is a big part of my story and my journey. And so having those touch points in the community, and then also I think my timing was just really good, which I'll put in the luck category, right. Where I made the decision that I had to leave because I wasn't happy. And at the end of the day, you are the only person in control of your own happiness. No one could quit my job for me. I was super unhappy, and my husband was like, can you you can do anything else. We can move into a studio apartment and it doesn't matter, just do anything else. And so I just started looking for things. And like I said, I ran into Jason Mendelson just at the right time. And it was because he asked me to volunteer at an event at the law school to help teach law students how to network, which is quite a feat. And so, in the middle of an M&A deal, living in Denver, I'm I got to say yes to this guy. And so I grab my laptop and I drive up there and I sit through this thing. And it's because I went to that event that I ran into him at the right time. And he said, how are you doing? I said, I need to find a new job. And it was just before they went out to raise the first Foundry Group Next fund, which was in 2016. So I think the time frame around this was early, very early, maybe January, February 2016. And so I went in to meet with him with zero intention of trying to get a job at Foundry, because it was always very clear to me that wasn't really a thing that was on the table. And really just to talk through, okay, you were a lawyer and you ended up in this, some would say more interesting career path. How'd you do it? And so we talked through a little bit of that, and then also opportunities. So Techstars was high on the list of things I should apply to. And then, okay, you have an MBA. Why don't you look through our portfolio and maybe you can go work for one of our portfolio companies, get operating experience. At the very end of that conversation, he mentioned, hey, we're bringing in this new guy, Lyndall, and we're going to execute a new strategy that we're adding to our platform. And he's used to having a team and he seems to want to hire somebody. Do you have an accounting background? I said, nope. He's like, I don't know if you're qualified for what he needs, but I'll at least introduce you to him. And so I met Lyndall, and I think we had, we just immediately connected. And he also was moving to Boulder from Texas. He didn't have as much of a local network, certainly in sort of the more junior crowd. And so again, I think I got lucky. I was in the right place at the right time. But I also had a JD and an MBA. I had been in a law firm. He knew I could work. He's smart enough to get that work done. The MBA helped. And then I also had, this experience with Fair Harbor. And so I had an understanding of a startup and a little bit of, maybe a little bit of credibility there. And so all of those things combined, and I think he realized anybody that's a quick learner can learn this business. I'm certainly not special. Any of us that get into venture, we're not special. got lucky probably,
Right.
had the right breaks, had the right timing. And a lot of it's learning the vocabulary quickly, and being able to build relationships. And so those are two things. Like, I'm a quick study and I can build relationships, and I think that really helped me land that job. And so he took a chance on me, and it seemed to work out.
So we should explain to people what you do, because people all over the world listen to this podcast. This isn't like it is inside the Beltway, but people don't know an LP from a GP from a whatever. So roughly speaking, when a venture capitalist invests in a company, that's a couple of people who have raised money from limited partners, who are the people who supply the capital. And they tend to be things like a foundation that needs to invest, or they're a pension fund, or a very, very wealthy family. And you'd be shocked how many wealthy families there are in the world that give the GP the money to do that, LPGP. But there's another thing that happens, which LPs, are people who need to invest money, don't know all the landscape of what GPs to invest in. And so there's people who put together funds, groups of LPs, and then they use their expertise to pick GPs to invest in. Did I roughly get that right?
Yes.
And you are one of those people. You are one of the people who invests, you also do, but not primarily directly in companies, but actually in other venture capital firms.
Yes. So Foundry Group, we still are primarily a direct shop. And I have started to work more on the direct investment side of the house. We can talk a little bit about that transition. But on the LP side, I think it's important to remember that the pools of LP capital at the institutional level, so the pension funds that you mentioned, the endowments, these are multi-billions of dollars. And venture capital is this like teeny tiny thumbnail inside of their private equity asset class, which is among a bunch of other, asset classes that they invest in. And so it's probably among the riskiest of the things that they invest in, but this like really teeny tiny piece. And so if you think about, a 10, 20, $30 billion pool of capital, spending time on making $1 to $10 million investments in seed stage venture capital funds, it just doesn't make any sense.
It sounds ridiculous, but it's true.
Yes.
Right? There is a group of people in the world that goes, $10 million is just too small.
Right. It's wild to me. I mean, I didn't even know what the words family office, I didn't even know that was a thing until I was a lawyer and we had like an estate practice. And I was like, so is it like an office where they all go? Or I don't understand what this means. And so I think from a scale perspective, like they just can't spend time on that, but they want that exposure. And so we are not a fund of funds, but the fund of funds sleeve of what we do, which is about 25% of what we do, and there are many pure play fund of funds out there, is we work with those LPs who just don't have the capacity or bandwidth, or really just doesn't make sense from a capital allocation perspective, for them to be spending time making these little investments. And especially where we play, which is mostly seed stage venture firms, there are a lot of them. And that's a relatively new phenomenon.
Right.
And so what used to be lots of angel investors running around has institutionalized over the past 10 years or so into these small funds that are 10, 20, 50 million, $100 million. And you need a lot, like you got to spend a lot of time and meet with a lot of managers to get the right context. I would say, it took me a year or two to get enough context. 4.5 years in, I feel like I've got a good sort of perspective on the whole landscape. And so what we're doing for them is we're sort of like an extension of their team, and we're the partner that goes and does either their venture portfolio or, their early stage, their seed stage venture portfolio or what have you.
And why do that? I mean, you're running, Brad's running a perfectly good venture capital firm. Why add this component to a perfectly good world famous venture capital firm?
Sure. So it's actually from a strategy perspective, it's super interesting. But it's a really natural evolution of our firm, of Foundry Group. A couple of things that have happened over the years. So we've generally been a Series A investor as an entry point. Series A at some point was the round after the angel round, but over the years it's become the round after the seed, and is now the round after the seed and the pre-seed, and all of the other things in between. And so as I mentioned, like sort of this institutionalization of the seed and seeing all these funds come together, one thing that the Foundry partners did with their personal capital over the years was write relatively small checks. So, being the high net worth individuals you mentioned earlier that might back these funds, writing relatively small checks, which a lot of GPs do, to the up and coming funds. And it was not only like partially a give first thing, just getting people in business, but also in the realm of not entirely altruistic. Well, first of all, great money to be made. If you look at the investing activity that they had over those years as a portfolio, even though they weren't managing it that way, it has like a really awesome multiple for a fund-to-fund strategy. Right. So backing a bunch of new managers early, not only great returns and a great way to make money, but also great deal flow. And they also just really like mentoring. And I think that, and part of it was how to spreading the Foundry ethos of sort of the way we like to play and treat founders and act within the ecosystem in this sort of very much repeat play industry, where how can we help make more people that act like that and create more firms that act like that, because it's good overall. So that portfolio, still exists today. And with that history plus Lyndall's history, so Lyndall Ekman, who I mentioned earlier, was the person that hired me. He ran private markets at UTIMCO, and venture was, again, one tiny piece of what he did, but he loved it. He actually had some really good early bets on what were then emerging managers who are now some of the top firms, which is USB, Foundry Group, I think Spark, True, some really great firms. Yep. And so he not only was good at it, but loved it. He had spent a bunch of time in Boulder. And so when he was looking for his next thing, he started noodling on this thing with Foundry Group with his sort of institutional track record and relationships, plus what the 4 GPs had done personally and the relationships that they've built, and really the goodwill that they've built in that seed fund community. If we put those two things together, Lyndall had also been, he had helped stand up a fund called Sindana, which he was an early backer of, Michael Kim and Graham Pingree. And the idea there was backing, what was called micro VCs, so these seed stage funds, early on. And so he had exposure through that and had seen a bunch of them and had developed relationships that way. Anyway, so putting that all together, the sort of evolution of Foundry, it made sense to bring those people closer by being their LP in a more meaningful way, giving our LPs access to that and exposure to that. And it ended up being about 25% of the first fund that we did with this, which was Foundry Group Next 2016 fund, where we still had our Series A fund as a separate $225 million vehicle. And we combined the fund investing with sort of like the select investment, so like our opportunity fund for our own early stage deals, as well as a new pool of capital for entering at that same phase that we would the opportunity stage, but for deals that we didn't do at Series A, because we had all these relationships and we would see these deals at maybe a post A or a B or a C round, and they were still really interesting. We could still see that huge upside, but we just didn't have an allocation for it. And so that was the first time we had that. And it made a lot of sense with this partner fund portfolio we're building. Their earlier funds could feed that. It has evolved today to the 2018 fund, which is everything together. So it's a $750 million vehicle. It's 25% allocated to the funds piece and then 75% to direct investments. And we think of our partner funds, there are 32 of them. So those are the VCs we invest in. And we think of them as essentially an extension of us. And it's almost like having a distributed firm where instead of building this huge firm where we have all these employees and, we get to cover geographically from a sector standpoint in a lot of ways, we get to cover so much more. And we have leverage and power from this huge network of partner funds that we've built. And when I say huge, it's 32 of them that are officially in the portfolio. So manageable, but big enough. And we see a ton. And so for me, I've started to not transition because I still very much cover our GP relationships and continue to make those types of investments. But now that I'm really close to those portfolios and those managers and understanding the companies and sort of seeing the breadth of what we see, it's like 1,000 companies on a look-through basis. There's just a ton of Series A opportunity for us. And we don't necessarily need to come in as the big Series A firm that's going to take the whole round and elbow at the seed players. Instead, we're more of a partner. And so we already have exposure. So we want this founder to do well, whether they choose us or not. We have a bit of an early look, right, from knowing these managers and seeing the portfolios. Of
course,
and so we come in as a partner to our seed funds and really work with them to catalyze rounds. And so it's been super exciting. So that's my direct investing is really focused on working with the partner funds to put deals together.
So I have a couple nerdy questions now that we've established what you do. There's these things that you're supposed to say in venture capital, and one of them is there's just too many seed funds. There's 1 million seed, and every day the number is bigger, right? Like I think 1 billion was the last number I heard. And yet there's a couple of other factors that I'll throw out. One is it's somewhat of a known fact that you get the highest returns for newer managers for seed funds, depending on how you manage it, as opposed to Fund X of some old firm. And there's an enormous amount of late stage capital in the world. Every day there's another $1 billion late stage fund, which would suggest that you need more capital at the early stages. And finally, there's no yield anywhere else in the world. I don't know where, there's nowhere else to put your money. Is it possible that there's not too many seed funds, but that there's not enough seed funds, or that they're not big enough, or that not enough capital is going into building companies that you can put Series A, B, C, D money into? Told you it was a nerdy question.
No, I like it though. So I think that's possibly the case. I think that it's not about number of firms. There's just everybody wants to be a VC these days. And I think there's a lot of people that are doing it for the wrong reasons. So I think that to me is the sort of, there's too many. It's also overwhelming as an LP that has to back these earlier funds because it's constant. But I think that, things have changed so much in the early stage where it's just the cost of starting a company have come way down, compared to 10, 15 years ago. I think in the last couple of years, and COVID might be changing this, because cost of living has come up, and you've got to compete with Google and Facebook and whatever for top talent, that it's becoming a little bit more expensive from a hiring perspective.
Right.
But in general, the cost of starting a company has come way down. That plus the fact that nearly every new company is a tech company. Not all, but every company is a tech company at this point, or touches tech, or is tech-enabled in some way. And so it's no longer its own sector. It really just is business, right? And so there's just so many more companies that qualify, I think, as tech startups that may or may not be venture backable. I think that's the question, is there's a lot of, is there a need for more ventures backing, or are there alternative ways of funding companies that might make more sense?
Right.
Just because there are these $1 billion later stage funds being raised doesn't mean that they should be raised. Or
for sure.
There are enough companies that get to that stage. And I don't know that necessarily throwing more money at seed companies means there will be more companies that make it to that stage, because it's super competitive to get there. But I do think, even beyond just the seed round, we're seeing now pre-seed funds. There's a lot of those. And so, people, and maybe it just looks like the old seed round, it's just called pre-seed. But what I'm seeing even more so is, I guess, to just get more companies in the mix. And then also, if you think about sort of disparity from a diversity perspective, and sort of who gets funded and who gets going, it's that friends and family round that is the most challenge. Just to be able to just get a product out or quit your job to start something, that early formation stage capital. There's a big gap there. And if we think about sort of, like I said, funding disparities, just think about who has access to that friends and family money.
Mm-hmm.
That becomes sort of the reason that one thing gets in business over the other, rather than sheer talent and, the idea and the market. And interestingly, I think that it's the same in venture, which is also why we have this disparity, where if you are raising, sorry, I sort of shifted away from your question a little bit. If you're a first-time fund manager and you really want to get into venture, and there's like you said, there's only so many jobs in venture, and so there's only so many people that have sort of come up in venture firms and can spin out and start their own thing with a real track record. And so the ways to get started are, you're already wealthy, and so you can build an angel track record and just start doing it. Or you've got to also, as a GP, raise that friends and family round, which is typically that first fund just to get in business. And again, you think about who has access to that kind of capital.
Yep.
There's definitely disparity there. And so, I like seeing LPs and family, especially at the family office level. And there's some institutions that are starting to think more and more about that and how to back emerging managers. And that also may shift, once this sort of different group of people has capital to then put to work, what kinds of businesses get funded.
Right. I'll ask you one layer more nerdy of a question, then we'll come back to something more interesting and wrap up. But, there's been the emergence recently of rolling funds led by AngelList. And so I just described LPs. I'll try to describe rolling funds, but it's a new type of fund. Yeah, thanks.
Better you than me.
Yeah, I'll probably get this wrong, but it's a new type of fund that an LP can invest in, but it doesn't have to be the same. You don't have to be the same level as like a family office. And basically, these funds are set up as a series of quarterly funds. So every quarter, there's a brand new LP. So instead of one LP, there's 4 LPs a year. And you invest in these. For example, you say, I'll put $25,000 a quarter in for 8 quarters, and then you get exposure to whatever the fund invested in each quarter. And if at the end of the quarter they haven't invested your money, it rolls over into the next fund, hence a rolling fund. And while that may not be a perfect description, the idea is that these are going to revolutionize and democratize and change venture capital. What's your thought?
Yeah, so I think your description is right. I think there's like a hedge fund aspect to it, right? Where I don't know what the gating mechanisms are, but you can sort of be in and out, which is an important distinction because LPs are among the most patient capital out there for venture funds, meaning that if you're committing to a VC fund, you're committing to, everyone says 10 years, but it's really like 15, if not 20 years of capital calls and of just waiting to see returns. And it's not like it actually takes 20 years to start seeing them, but it's patient capital. And that works mostly for larger institutions or super wealthy families that they like sort of the risk aspect to it and they don't need the money back tomorrow. I think what this does, it enables 2 things. It enables more people to be LPs if we think that that's a good thing, because they can write smaller checks. They don't have to make as big of a commitment. And they're, at least from a capital commitment perspective, they're not sort of tied up over a long period of time, but you can just keep investing. And then on the GP side of things, it just allows people to get in business more quickly because one challenge is like you just want to get started, but you've got to round up enough capital to have a first close for it to even make sense for you to be in business. I always ask GPs when they talk about fund size, I'm like, well, what's your MVP? If you can't raise 50, does 25 work with your strategy, right? And so this allows people to just close some money and get in business and start making investments, which can be a good thing. For me, so I like the idea that, there's a democratizing and accessibility aspect to it. The challenge that I find is that I think it's going to create it's going to create managers who don't necessarily have discipline around portfolio construction, which if the goal is to get started on AngelList, but then become a more institutional fund and sort of like shift your LP base over time and raise a bigger fund that's a little bit more of a traditional model, then you aren't going to because of the way these funds work, you're going to have a different amount of capital sort of every quarter. You're going to hope that you know what it looks like, but you don't necessarily know what it looks like. And so given that uncertainty, you could see people just really doing sort of what angel investors do, which is I'm going to write whatever check size I want, with whatever pacing I want, and sort of just do deals, right? And not necessarily think about the construction of this portfolio, which is how many deals are going to be in it. What does ownership look like? Can a given deal move the needle on returning your entire fund? And so the sort of, I don't know, the in and out, and it just it's sort of like it's a new thing almost every quarter, I think can be challenging. And then you also think about the way that startups and financings work is not on I think it's quarterly, but maybe I'm wrong, the way the rolling funds work.
Yeah, no, it's quarterly.
They don't work on a quarterly basis. Right. So it's okay, it's day one of Q1, so we're going to start fundraising now, right? It's so you may get into situations where you don't have capital when you want to make an investment. And so the lack of certainty there too can be challenging. And the worst thing is to have a deal that you really want to do. And yet, I mean, and this is a challenge that people go through if they're fundraising while they're in the market. But is sort of like, oh, I want to do this deal, but I can't commit to it because I'm dealing with my next quarter and I don't know what's coming in. And so without LPs being a bit more committed,
yeah,
I think it's challenging. I think there's probably workarounds from a relationship perspective where you can, build relationships with LPs and sort of have at least verbal commitments on sort of what their expectations are.
Yeah.
But you see market pullback. I mean, I know we keep saying this is going to happen.
Yeah.
If it does happen, that could be super challenging for a bunch of these funds who were expecting fresh capital, and all of a sudden people are like, I can't do it this quarter.
Yeah, they strike me as being super complicated. Like a new LP every quarter is like, gee, I mean, I can't imagine, and this is what AngelList is doing. Like that's their value proposition. I can't imagine the legal and like the paperwork behind this thing.
I think that, so AngelList, I think similar to sort of, you can start a fund on AngelList. I think that they deal with all that stuff for you.
Yeah, they do. Yeah.
But relationship beyond the legals and all of that stuff, which I mean, I
them.
Like, what if you're taking comments on your LPA every quarter, right? Like, I mean, obviously that's not how this is going to work, but there's a lot of herding cats that goes on with LPs. And if you think about newer managers, they often end up with these funds that have, close to 99 is the cutoff, but they'll have like 90 individual LPs. And it's just it's a lot to deal with. And we often find that the smallest LPs take up the most of your time.
Yep.
And so from that perspective, it seems chaotic. And so I don't know, I talked to someone about it recently. I don't think my intention was not to talk him out of it, but it was, I get why you want to do this, but as you think long-term about what you want to be and what you want to build, if it really is that you want to build sort of a real firm, there may be trade-offs here where you at least just have to consider in starting out this way.
Yeah, I think that's right. I think when you build a venture fund, and by the way, no one should ever complain about being a venture capitalist because compared to being an entrepreneur, it is way easier. Let me say that first. But it's hard. I mean, you don't get paid. You talk to a million people. You scrap and you scrape and you build something, and that's part of what the LPs are investing in. Like somebody who's going to scrap and scrape and build something that they can invest in fund 2, 3, 4. If you're doing a rolling fund, you may be more tempted to be like, well, I'm doing this part-time and I'm doing it because if I get a couple hits, then I become a venture capitalist. But if I don't get a couple hits, boo-hoo, I'll go work at, Facebook.
Yeah.
Like, there's you can do it, and people do this without even quitting their day job. You can do it without sort of maybe the seriousness of purpose that somebody who's really out there like, yeah, I'm going to grind this out till I have a fund, is doing.
Right. And I would be very surprised if any institutional LPs back a rolling fund. So that'll be an interesting thing to see. I don't think it's a thing that we would consider. But I think also, just in thinking about that, like if you think about the risk that entrepreneurs take in quitting their jobs to go to build their thing from zero, as an institutional LP, like I want someone that's that committed, that like can't do anything else this job and they really, really, really want to do it. And so I think that's a bit like we're looking for that same level of drive and hustle as you would with a founder. What this does do is it might be an alternative for folks that run syndicates.
I think that's right. Yeah.
Have like a pool of capital where you can go do multiple deals as opposed to having to round it up for every single deal. But you know what? I think innovation is good.
Right. Yeah.
People learn regardless. And so I like to see sort of any innovation in this industry. And I like, especially the accessibility aspect of it, I think will be net positive.
Well, let me ask you, kind of finish up with this, but I'll ask you about this. I just wrote down, I was going to list out a couple of the venture capital firms you've invested in, like Freestyle. I wrote down Moxie, I wrote down Uncork, I wrote down Pioneer Square Labs. That was just kind of random. And as I was looking at this, I've had a lot of women investors, Trey Vasala, Maha Ibra, and Dwayne, like on this podcast more than any other podcast, I think. But just grabbing those 4 companies, Freestyle, woman partner, Moxie, that is a woman, Uncork, woman, Pioneer Square Labs, woman partner. Mm-hmm. Did I get lucky, or is there some is this thoughtful? Like,
I think it's a mix. So it's definitely thoughtful, but it is not we will never be check the box investors, and we will
that's
never
right.
be driven by mandates and things like that. Those are four extraordinarily talented teams and really successful firms. Happening like they happen to also have a woman on the team, which we think is awesome and might be driving some of that success. So I think, I think we are evolving, and we are intentional about making sure. I think it's not only about the investment decision, because at that point you're sort of working with what you've seen. And I'm speaking a little bit more broadly about diversity in the industry generally. It's the pipeline that matters. And I think for years we've heard that, well, we would invest in women or in Black founders or whatever, but we just don't see them. There aren't that many of them. There aren't enough. And so this pipeline excuse is a little bit BS, and it's more and more BS every day, where there's plenty of people sort of out there doing things. It's just whether or not they're in your pipeline. And so I always say it's not a pipeline problem, it's a your pipeline problem.
Right.
And so that's something that I think we've been thinking about for many years at Foundry, and we're working on, and we've backed female founders over the years. We don't have a great track record when it comes to racial diversity. And we've got a number of female GPs. I'd like to see us have more. But it's really about focusing on what's feeding the pipeline. And for us, we're network investors, and we will, that's just, and I'm sure Brad talked about this. You interviewed him. Brad will tell you that everything he's ever done in his life, there's a network aspect to it. And so the way that we invest is very network driven. But what's important, the important thing is to make sure that your network is not exclusive, and that your network doesn't just look like you. And so I don't think we ever go, there's a lot of people that will say, well, network driven venture capital investing and warm interest, that's the problem. And that may be true, but it's really hard to see that changing just based on the way that the things have worked. And maybe that will change, or maybe certain firms will figure out how to do it differently. But we know that network is our superpower. And so what we're thinking about is, how do we make sure that we broaden our network, that our network is more inclusive and more accessible, and not only from an investment perspective, but also the talent coming in to the companies that we invest in, and to the companies that our partner funds invest in. And so just making sure there's just that the network is broader. And so that's, I think, an important piece of thinking about diversity, and who are the GPs, who are the check writers, and making sure that we have broad diversity across the network, make our network more inclusive, and therefore that should feed really better companies, right? Because diverse companies perform better. And I would say the same thing is probably true of investment teams. Yep. And really the diversity of perspective. It's not necessarily specifically gender or specifically race or anything. It's really the backgrounds, which often, and the perspective that you have, which in some ways are driven by things like gender and race and sexual preference.
Yeah, as people, my partner Jonathan Abrams invested in a company called Front, which was, Sequoia has now done, I think, the A, the B.
I don't even want to know what the last valuation on that.
They're doing very well, but the founder was a woman. If anyone thinks pattern recognition is a thing, the founder was like a waitress, a woman from France. So but he's not out looking for more women from France. And when Zoom got founded, nobody wanted to invest because the guy, he was too old. He's like 41 or whatever.
Right.
So if you can release those things, and that's a whole complexity we've talked about on this podcast, but if you can release those things, you make more money.
Right.
You do better.
I think pattern recognition is still in some ways a thing that you need. And I think it's more about experience over time rather than pattern recognition. But there's so much bias ingrained in that it's hard. And I think it's a thing everyone needs to be working on, is sort of separating out qualities of a successful founder and a successful company.
Yep.
And that are not related to what the person looks like or where they went to school, or probably a bunch of factors that sort of aren't really, so it's, right. I think there's some unpacking to do to try to remove some of the bias and really identify the things that actually are important, that you do want to see those patterns.
Right.
Somehow figuring out how to remove the bias that's going to prevent you from investing in something that's going to be great.
Right. And while venture capitalists should try and do try, and we talk about it a lot, like it's hard. like
Right.
removing bias, like if that was just a solvable problem, the world would be a better place. What, from your
I'm sure it because I'm not a Star Wars person, but it's like there is no try, there's only do.
That's right. That's right. So what do you now going forward? Like, what are you looking forward to in the future? Where COVID's kind of hit your industry and now it's become it's either a fact of life or it's not going to be a fact of life, but it's not going to be a surprise. Colorado's probably on fire like California. Like, what do you see from your perch or maybe it's not, I don't know.
Sorry, I missed the question.
What are you looking forward to? Like, what do you see in your portfolio companies and your GPs where you say that, hey, this is going to be either good or at worst interesting?
Well, it's always interesting. So I'd almost challenge the statement that this has been this has hit our industry. It's sort of crazy what we're seeing versus what we expected. The valuations have only gone up. There's so much activity. It feels almost insane, but we'll see. But I think that there's every single firm is doing this exercise, or not every single firm. A lot of firms are doing this red, yellow, green exercise in the wake of COVID. And so there's this sort of, and this is a thing that was like everyone started doing in March and continue to do, and I think we'll continue to do quarterly, at least in the near term, which is essentially like some companies have headwinds and some companies have tailwinds and some companies are somewhere in between due to COVID. And so there's the COVID analysis, and then there's the longer term analysis of, okay, if we get through COVID, what do we think the trajectory of this company is? And so I think that, some of the positive is you're seeing a couple of things happen. I think that, we've always believed that you can build great companies anywhere, and that talent is not concentrated in the Bay Area.
Mm-hmm.
And so I think more openness to remote work and hiring people remotely, even if the intention at some point is to have everybody in one place, means that people are thinking about talent differently, I think, and of where to find it and where people can be. And there's an inclusivity aspect to that. And I think there's also just, sort of cost benefit to that, to not having it so concentrated in the Bay Area. So I like that. And I think companies learning how to work remotely is a positive, because it can be extremely empowering, especially if you think about, I'm a mom that works. I sort of miss the office, but it's actually really nice to be home because I get to see these moments of my toddler throughout the day.
Mm-hmm.
I'm not with all day, but I get glimpses of things I wouldn't have if I'd been on the road going to annual meetings, or if I was at the office all day.
Right.
So I think there's some positive aspects to it. I think just accelerating the pace of innovation with respect to education, not only in schools, but how workforces are educated. I think that's interesting. I think there will be a focus on just breaking down barriers, continuing to innovate in that
Right.
way, how we all need to communicate with each other. I think some negatives, I think we're all super tired of Zoom as I sit here with you on Zoom.
I never used to do this. On Zoom, I would always insist that people come in, and it was always a better product and a better experience. But what are you going to do?
To Zoom now. So I think there's a ton of fatigue, but I think a lot of that fatigue is driven by uncertainty, by sort of in the market, in the economy. We have an election coming up, in healthcare. Is somebody I know going to catch COVID? Am I going to catch COVID? So there's all of that, I think, stress in the system that's contributing to the exhaustion. But the Zoom all day thing as well is exhausting. I'm personally an extrovert, but I think even introverts miss some level of human interaction.
Yeah.
And so I think that's tough as well. But, I think another thing we're seeing is that a bunch of, sort of going back to more business side, a bunch of big enterprises and those sort of companies that maybe use on-prem software realize very quickly that they this whole sort of, we need to innovate and blah, blah, blah. And the thing that probably just kept getting pushed off every year actually matters and is going to happen now. And so I think that's going to be, that'll be huge for our industry as well.
Yeah. Well, this is great. How do people find you if you want them to find you? Is it a Twitter thing or a LinkedIn thing?
I do a little bit of the Twitter thing. I'm more of a follower than a tweeter. I'm J Freester which is what I wanted my married last name to be. My husband wouldn't go for it. My maiden name was Freeman, and his last name was Hester, and so Freester I thought would have been.
Freester's a good one.
I think so. So I'm Jay Freester on Twitter. I'm Jaclyn at Foundry Group. Our emails are easy to find. They're on our website. And I try to be as responsive as I can. But the email thing gets overwhelming.
That's right. All right. Well, thank you so much for doing this. This has been great.
It's been super fun, Ken. Thank you so much. Thanks for having me.
All right. This has been the Something Ventured podcast. Jaclyn Hester has been my guest. Talk to you next time.